Disney now looking to cut costs after disappointing fourth quarter results with underperformance in both its park and media divisions, while slowing subscriber growth is a headwind for the streaming industry. RBC Capital's media, cable, and telecom analyst Kutgun Maral is here to dive into the report. Kutgun, thanks for taking the time here with us today. If there's one thing that really sticks out from this report, given some of the headwinds that the company had to acknowledge on the call, what does this growth pathway even look like for a streaming business that has really kind of been that core element that investors have hung their hat on for growth?
Yeah, I mean, I think, not much has really changed in terms of our medium to long-term outlook of the streaming business. The timelines that management had previously talked about in terms of hitting break even or profitability with Disney Plus in fiscal 2024 still remains intact. But I think, closer to today and near term, the pressures are certainly larger than we expected. And the DTC losses were certainly a headwind in terms of expectations coming into the print last night. And so, it is a competitive marketplace. Management is investing in programming. It continues to expand across the globe in different markets. And it's a pricey endeavor. But again, in the near term, expectations for segment OI in 2023 were certainly well below expectations. We just have to kind of get through this near-term volatility until the story really starts to refold to what we were hoping for in 24, unfortunately.
Do you trust management's timeline on profitability for that DTC business?
I do. I think they have great visibility. When you think about the top line expectations and the benefits that should start accruing from the upcoming price increase, from the upcoming ad-supported tier launch in the United States in December, along with a harder look at the cost side, both between programming and non-programming costs at Disney Plus and other streaming services. I do think that they have a good handle on being able to hit those profitability timelines that they had previously outlined. But again, for the next quarter and this current year, certainly there's a lot more pressure than we anticipated.
Disney Plus saying that they've already secured more than 100 advertisers for the domestic launch window and over 8,000 existing relationships with advertisers, they also said on the call too. What type of net contribution to their margins are you expecting from this advertising tier?
Yeah, it's a great question. And I think the reality is that the initial contributions will be a little modest. It's going to take time for that ad-supported tier to grow customers. And management, I think, will be very measured in how they roll out this new service so as to not disrupt the consumer experience. So, it's probably more of a back half of 2023 and more meaningfully in 2024 kind of event in terms of the upside we see from advertising. And the reality is also that the current ad market is challenged. And we see it from other companies like Paramount, Fox with Tubi, called out some issues from the digital ad marketplace. And so part of the upside on this ad-supported tier will hinge on hopefully an improved macro environment as we move forward as well.
Does Disney need to be concerned about Netflix reportedly looking into getting into the sports business?
ESPN is an incredible brand, and they've been at this for a really long time. They have long-term deals inked. And so I don't know that it's a near-term concern, but whenever you have a very serious player entering the marketplace that could potentially continue to bid up sports rights in the future, that's certainly something to keep an eye on. Look at what's happened with Amazon and Apple in terms of how disruptive they've been across the sports ecosystem. So again, perhaps not a near-term concern, but something that we're focused on, and I'm sure management will be too.
Yeah, absolutely. I mean, those sports partnerships and the rights to broadcast are massive in terms of the active viewership that you see and then the continued engagement when you are broadcasting those games as well. For Disney, if we can dive in briefly to that kind of parks and resorts, parks and experiences side of the business too. I mean, as Sazi was mentioning earlier in the show, this is where they usually are able to take some of those margins and push it into some of the other parts of the business that are major investment opportunities If you see a continued lull in parks and resorts, what does that spell out for the ability for Disney to continue to invest at the rate that they have in other parts of the business?
Yeah, I mean, I would characterize the parks as actually having been strong for both Comcast at NBC Universal and for Disney as well. The demand trends that they're seeing in the United States, they're seeing across the cruise ships, in Paris, in Shanghai up until the recent closures, they all remain pretty strong. And the forward-looking commentary from management spoke to a pretty strong December quarter and holiday season as well. I think the broader concern that we have at the parks is just the margin outlook. Recall for most of this year, parks have just been firing on all cylinders in terms of being able to recover from the COVID lulls and showcasing really strong incremental margins based off all of the changes and investments management had made during COVID in terms of the cost structure. But this last quarter, margins were quite a disappointment. And, when we think about the next year, I don't know that anyone has a ton of confidence that we're going to go back to the meaningful margin expansion that we saw in 2022. And so, that really remains, the toggle in terms of how do we think about management's ability to hit its high single-digit operating income target for next year, and more importantly, what does the medium to long-term growth algorithm look like? And so that's our key focus, and it's unfortunately a hard one to answer at the moment, especially when you think about the fact that every day that we move forward, it seems like the macro environment is getting more challenging, and I don't know that greater incremental pressure from the macro is really baked into management's targets.
Perhaps you could settle this debate for us, excuse me, Kutgun, that we were having just before. What is this stock likely to trade off? Is it the fortunes of the parks business going into a potential recession or the continued subscriber growth in DTC?
I mean, increasingly, the way that these stocks trade have evolved over the years. It was a different framework when it was a bull market and streaming was valued on subscriber growth and revenue growth. And now when the markets are certainly a lot more volatile, we're seeing investors increasingly shift towards just a consolidated total company valuation on EBITDA or PE, which encompasses all the clearly all the dynamics that are going across the business. In that lens, the parks are the real growth driver and profit center for the business at the moment. And the streaming side is generating meaningful losses. If you have the patience as an investor to look out 2-3 years, you'll see a meaningful inflection from the contributions from DTC, of course, as they hit profitability, as opposed to 1.5 billion of losses last quarter. And then, the total company growth outlook really starts to look pretty attractive in 2024 and 2025. But unfortunately, in this kind of tape, it's difficult to ask investors to have that kind of patience. And so at the moment, it really hinges on what's going on with the parks and can they continue to execute and drive strong per cap growth, attendance growth, and of course, margins.
How I read that was I was right and our producer was not right. You get to come back. Kutgun Maral, RBC Capital Markets media analyst. Great. Always good to see you. We'll talk to you soon.
Thanks so much for having me.